It's Matty the Batty back with another chapter of Mortgage A to Z. It's a mortgage, which is just a euphemism for a loan. That means you have to pay back the principal with interest because nobody rides for free. But how much depends on the term of the loan and the loan features. And then there's that question of deductibility. I'm here today to give out F's, as in the letter F, for finance, specifically finance charges. So what do you know about borrowing money from the bank in the form of interest with some pros and cons to borrowing? Here we're going to discuss a few things to help you get your arms around. First, why take a mortgage? That's a great question because some remark debt is a bad thing. Yes, debt is debt, but the mortgage interest deduction allows homeowners the benefit of deducting interest from their taxable income. Just note, it's not unlimited. First, it's available for loans secured by a primary or secondary home. Credit lines and secondary credit loans may also be deductible, but there's limits and prerequisites. Now, back in 2017, the Trump admin passed the Tax Cuts and Jobs Act, which reduced the limit of deductible mortgage debt to $750,000. Prior to this date, it had a limit of $1 million or $500,000 if you filed separately. To claim the interest deduction, you must itemize your deductions opposed to the standard deduction. So you're going to need some other deductible expenses, but you also have to prove use as if the funds were used to buy, build, or improve a home, securing that loan. Interest on mortgages used for credit card debt or vacation may not be deducted. For those with high income, the amount of interest you get to deduct may be reduced or even phased out. And likely if you're single with over $164,900 in income or a married couple with over $329,800. So you may be subject to the alternative minimum tax, the AMT, which limits the benefit of many deductions, including the mortgage interest deduction. And speaking of that good old HELOC video, the Tax Cut and Jobs Act changed the rules for deducting interest on second mortgages. Now the funds may be used to borrow, buy, or build, or improve that home that secures that loan. Now I'm not an accountant, but I do know a really good one. Please consult with a tax pro or do your own research for the complete regulations or the most recent changes on interest deductibility. So now you have the rules of the game. Is it worth your while? Well, what else should you consider? How about the big payback over the multitude of years? Now, depending on your financial wherewithal, you may follow the Dave Ramsey school of thought, using debt, but doing it only sparingly and goal-oriented to keep your life simple and organized. If you're more experienced, you may agree more with Kiyosaki, who uses debt according to the tax code in ways to reduce his tax liability. Both are great, just different interpretations on how to best use leverage. Now, to make this more effective, let's use a real-life example and face off these two with yours truly with a 30-year fixed note, and compare the Ramsey 15 and the Kiyosaki 10-year interest only. Now, you at home, you keep score, but let's just see who accomplishes what they wish. And to level the playing field, we're going to assume a $250,000 loan amount, paying an interest rate of 6%. So, where are the players going to be in 10 years' time? So starting easy, the 15-year fixed. Your monthly payment in terms of principal and interest is going to be $2,110 per month. The total interest paid over the entire 15-year term is $129,736, and you're going to be debt-free by 2039. Next, the 30-year. Now my payment goes down to $1,499 per month, but my interest expense goes way up to $289,595 for the term, with the end date of 2054. Now, with the interest only, since you're not required to pay back the principal during that first 10 years, your payment's going to be the lowest and cheapest at $1,250 per month. But with that figure, you're not, again, paying any principal during that period, and then therefore your starting and ending balance will remain the same at $250,000. Now your interest expense is going to be $150,000 over that 10-year period. So how does that compare? The interest expense on the 15-year is $112,279. For the 30-year, it's $139,079. Meanwhile, the interest only is $150,000. Now let's talk about balances in 10 years' time. The 30-year fixed has a balance of $209,215, while the 15-year fixed, if pay down that note to $109,122. Meanwhile, for the interest-only note, you still have a balance of $250,000. So is there a clear winner here? Well, that depends on what your objectives are and where you see yourself in the next decade. And is this home for primary use, vacation use, or investment use? These are all great things to consider about leverage, and there's just many ways to think about it. I don't think there's ever a right or wrong answer. It just really depends on what your goals and how you're trying to make leverage work for you. Now that's all I have from Matty F, and the F is for financing.